Joining us now is Saira Malik. She is Chief Investment Officer and Head of Equities and Fixed Income at Nuveen. And Saira, I'm guessing you feel a little like the rest of us. I slept through my first alarm this morning. We've had other guests who have slept through their alarms this morning. It has been a lot to follow, to take in, and then to try and figure out what to do with it all. Where are you?
Well, Becky, I always set 3 alarms when I'm on the show, and I'm glad I did that today. I don't think we're out of the woods yet. The Trump put and the 90-day pause did take the worst case off the table, but we're still worried about 3 things. What does this mean for the economy, for China, and also earnings season? So starting with the economy at 10% base tariff rate, plus what's happening in China, that still takes about 1.5% off GDP for 2025. At best, that's skirting a recession. I still think it gets us into a mild recession. And it should add about 1% to PCE inflation. So that's going to tie the Fed's hands. Now, looking at China, the continued escalation there, I think, is going to create noise and volatility for the markets. And it also brings about the worry that we have about bond yields, which have been spiking, which really doesn't make any sense during this period where people are expecting the economy to slow. The worst case scenario there is our concern that perhaps the rest of the world is not viewing the U.S. as a safe haven anymore. And that would be a headwind for equities and fixed income. And then finally, as you were just talking about, first quarter earnings season kicks off tomorrow with banks. I think overall earnings season, about 7% growth is expected, but that's going to be backwards looking. What we're thinking about with the banks is what's going on with capital markets. We expect strong trading, but weak M&A. Is there any risk in the consumer credit cycle? What's the consumer doing? What are loan loss provisionings look like? All of that's going to be important as a forward look from their commentary.
Yeah, that I guess is a big part of the question. I guess we're fortunate to have earnings season hitting us now. It will give us a lot more insight into how companies are thinking about these things. What do you do ahead of that? Do you hold, wait and pause? Anybody who sold last week or earlier this week got punished massively yesterday. But Jeremy Siegel was on with us earlier saying he doesn't expect us to get back to the all-time highs anytime really soon. Certainly not this first half of the year.
I mean, that's the issue with trying to time the markets. Usually investors tend to do it at the wrong time. So we highly recommend. Yeah, we highly recommend staying invested for these reasons, because when the markets whipsaw, you could never get in early enough to catch something that happened yesterday. While we may have hit the lows for this period yesterday, but I think going forward, we're still going to be in a trading range and very dependent on tariff news and some of these negotiations that we see for the next 90 days. I don't think a strong 7-8% earnings season of earnings growth is going to get us out of this, because we're going to be worried about the earnings slowdown that we see that may be coming in front of us. So for investors, I think, hang in there, keep a diversified portfolio. Hold on to quality stocks. We like areas like dividend growers. These are companies that consistently raise their dividends, so they're well protected during a recession. We like infrastructure companies, which tend to be more economically resilient and are a play on building more in the U.S. And then look at select tech. A company like Broadcom seems very resilient here. AI demand actually looks quite inelastic during this cycle. So in tech, you can start to pick through the carnage with something like Broadcom.
Sarah, you were just pointing out that we're going to be pretty dependent still on the tariff news that comes out. If we were to hear that there were some deals that were cut, maybe with countries like Japan, South Korea, Vietnam, the UK, would that ease concern? Or is it really the biggies between China and the EU that matter, just in terms of what kind of an impact that will have to earnings and to our broader economy?
I think what the last week has told us, and yesterday, is that the Trump administration is increasingly focused on China. And I think that is where a lot of the escalation will happen. Some of the winners are exactly who you mentioned. If China loses, who wins? Areas like Korea could win, Indonesia, Thailand. These could be emerging markets that actually benefit with increasing escalation of tariffs on China. I think a lot of that, though, would be short-term news. So this is why I think volatility will remain high. It was great to see the VIX drop from 60 to the mid-30s yesterday. But I think volatility is going to remain high on all of these data points, because we cannot really get a handle around what does it mean for the U.S. economy at this point and for inflation. We can only take guesses here. I think, you can run your numbers with a 10% base tariff. You're getting very close to a recession. Where we were on Liberation Day, I think, was pretty clear that we would have gone into a mild, at least a mild recession, probably a deeper recession. And so it's great to see that worst case scenario taken off the table. But it doesn't mean that there aren't some fairly poor scenarios still on the table that are likely to happen because of these tariffs.